Zillow's algorithms show prices holding steady in big cities, but actual closings tell a different story. Zillow charts look smooth, real sales look jagged. A recent investor-owned listing covered in the research had to slash its asking price multiple times before selling far below its 2022 purchase price. And that's not an isolated case. Take Metro Atlanta. While official data shows just a minor dip, MLS feeds reveal active listings have jumped by 254% since 2022. That scale of inventory growth signals distress, not stability. And yet, the headlines keep saying housing is under control. The data nobody wants to talk about. The story behind the glossy headlines looks very different once you open up the data few people discuss. The data nobody wants to talk about is buried in local MLS feeds and Realtor.com figures, and it paints a picture that national averages simply smooth over. Instead of gentle corrections, the numbers show sharp inventory jumps, mounting price cuts, and falling contract values across markets that were once described as immune. Take Phoenix. Wolf Street's analysis puts the city down about 9% from its mid-2022 peak, and Realtor.com reports that 33.2% of active listings are cutting prices right now. On the ground, sellers chasing yesterday's valuations often go through multiple reductions just to get a single showing. Drive through neighborhoods in Gilbert or Goodyear, and you see the signs lined up. Price reduced, seller incentive, and open house this weekend that no one attends. That's not a minor trim in value. It's fatigue settling into a market that used to run on FOMO. Austin's numbers are even more blunt. Wolf Street ranks it among the sharpest decliners nationally at roughly 22.8% down from its pandemic peak. Realtor.com shows about 32% of listings sitting with cuts at any given time. Builders who bet on endless inflows of tech workers are watching subdivisions outside Pflugerville and Leander stagnate. Whole streets display banners offering buyer credits, free appliances, or straight price drops. The lawns tell the story better than the averages, with too many for sale posts competing for the same thin pool of serious buyers. Denver shows a version of the same problem, though framed differently in the press. Official reporting highlights resilience, but Realtor.com logged Denver's active listings up roughly 88% versus its pre-pandemic baseline, and 33.7% of those have already chopped prices. Median list prices are reported down around 3.6% year-on-year. Sellers in condos and smaller homes that once went to investors are now watching them linger for months. Attend an open house in a townhouse community near downtown, and you'll count more cookies on the tray than visitors through the door. The disconnect comes from how headline indices add up averages while leaving unsold or repeatedly reduced homes out of the clean statistics. A national figure showing modest single-digit declines implies stability. But homeowners in fast-growing suburbs see outcomes that swing far more dramatically, 15 to 25% below initial list levels once you add up price chopping to the actual closing number. And those comps weigh on new appraisals. Each cut drags the next transaction lower. Buyers absorb this imbalance differently. Seeing hundreds of listings pile up makes them cautious. Even if nominal prices have ticked down, the abundance of choice encourages waiting. When entire metro areas record 30% or more of homes cutting prices in a single quarter, the logic flips. Buyers hold back because they expect tomorrow's listings will be cheaper. Sellers, realizing this, fall into a pattern of cuts and concessions just to catch attention. The quiet at open houses, the weeks of no offers. These factors never show up in median price charts, but for participants, they define the market. This supply buildup also changes dynamics for professionals. Loan officers wrestle with appraisals that can't justify contract values because nearby comps keep sliding. Real estate agents adjust from managing bidding wars to counseling patients through long marketing periods. Builders struggle most visibly because lowering the sticker price on brand new inventory risks alienating last year's buyers who paid much more. These frictions ripple outward through lending, absorption, and even investor confidence. National outlets can smooth all of this into tidy averages, but the regional MLS stats don't lie. When Realtor.com tracks 1/3 of listings cutting prices in markets like Phoenix, Denver, and Austin, that's not equilibrium, that's distress. And when research documents active listings in Atlanta up 254% from their 2022 levels, it underscores how headline price medians mask the reality of swelling unsold stock. The indices tell one story, but the raw data shows a foundation weakening under visible pressure. That widening divide between the narrative and the field data doesn't just confuse homeowners. It sets the stage for the group of players that moved most aggressively during the boom. And what they do next is going to reveal the market's true direction. Institutional fire sales begin. Back in 2021 and early 2022, the biggest investors in housing acted as if there was no ceiling on prices. Institutional buyers were flooding suburban markets, outbidding regular families with all-cash offers, and treating homes as interchangeable assets. Their assumption was straightforward. Housing appreciation looked unstoppable, tenants were plentiful, and ultra-low interest rates made the math look bulletproof. Instead of picking off a handful of properties, these firms built entire portfolios, sometimes moving hundreds of homes in a single transaction. That strategy only worked as long as appreciation held steady. Once mortgage rates doubled and buyer demand thinned, the spreadsheets no longer balanced. Rental yields weakened, exit assumptions failed, and the models that justified aggressive growth shifted to capital preservation. Research has shown this clearly in recent portfolio data. In some Sunbelt areas, large batches of investor-owned rentals have been listed and repriced down, with discounts reaching into the double digits. One case highlighted in the research involved a Blackstone-owned suburban home that had its ask cut multiple times before finally selling tens of thousands below its prior estimate. For corporations, this wasn't an emotional defeat. It was a rules-based choice. Liquidate and preserve cash before the slide accelerates. This is the core difference between institutional sellers and ordinary households. Families often resist taking obvious losses, holding out for seasonal demand, or even pulling listings off the market altogether. Institutions do not hesitate in the same way because the houses sit inside broader portfolios. As the research notes, those holdings are managed according to performance targets and liquidity thresholds. When returns dip below expectations, the algorithms dictate sales, regardless of neighborhood context. And once those discounted closings print, they become the new comps, pulling valuation benchmarks lower for every homeowner nearby. The speed of these adjustments is reshaping local markets. Consider a street where most owners are still anchored to high pandemic-era values. If even one institutional sale closes at a steep markdown, comparable appraisals have to reflect it. Buyers adjust instantly, lenders follow suit, and surrounding homeowners find themselves dragged down by a single corporate decision. The effect is magnified when funds concentrate in specific neighborhoods because blocks of homes can all hit the market under the same seller, stacking reductions on top of one another. Homeowners often describe this as institutions crashing their neighborhood values. But to the investors, it's simply executing the playbook. Dispose of underperforming assets before capital is eroded further. Remember, this isn't the first time big money operators underestimated the risks of mass housing bets. The Zillow Offers program managed nearly the same thing from a different angle, misjudging how quickly properties could be flipped during a cooling market. That misstep cost Zillow roughly $880 million before the program was shut down. The point is clear: large-scale housing bets can backfire, and when they do, the need for liquidity trumps patience. The contrast between 2 years ago and today is jarring. In 2021, hedge funds and real estate investment trusts were the ones driving the frenzy, overbidding, waiving contingencies, and making neighborhoods feel like auctions. Now they are unloading in volume, setting new price floors with every discounted bulk transaction. The psychology of endless appreciation has turned into mechanical deleveraging, with little concern for the individuals whose equity gets undercut in the process. For local markets, the fallout is unavoidable. As more portfolios come to market, institutions will continue to post sales below surrounding asking levels. Homeowners can either adjust to the discount comps or wait indefinitely as their listings go stale. Either way, once those numbers update in sales records, they establish a market truth no headline index can erase. The irony is obvious. The very players who helped inflate suburban prices with indiscriminate cash buying are now accelerating the descent with equally indiscriminate selling. Buyers who watch closely see these transactions as the most honest indicators available. They cut through the national averages padded with delayed closings and show what money is truly willing to pay today. Each portfolio sale, each failed rent-to-yield property, marks another step toward recalibrating the market back to levels that actually clear. And unlike hesitant homeowners, institutions won't wait for a seasonal rebound that may never arrive. They exit, they book the loss, and they move capital elsewhere. As this process unfolds, it exposes something deeper. The market is not being steered by soft landing forecasts or reassuring media headlines anymore. It is being reshaped by the raw arithmetic of portfolio management. Algorithms scan the data, measure declines, and execute disposals with no regard for neighborhood sentiment. That's why in communities tied heavily to institutional ownership, equity positions are evaporating faster than national charts suggest. And while those national charts still promise steady curves, the lived reality looks nothing like that. Families comparing their Zillow pages to the closed comps on their street are beginning to see the gap. In the next part, we'll dig into why those neat online valuations seem frozen in time, even as real sales around them reveal a very different pattern. Why Zillow still thinks everything is fine. Why Zillow still thinks everything is fine comes down to how its numbers are put together, and why they often diverge so strongly from what people see happening in their neighborhoods. Pull up Zillow right now, and the graphs look like minor ripples, small shifts down, never anything dramatic. According to the automated outputs, most markets are gliding gently lower. But those charts are only as real-time as the data sources feeding them, and Zillow's model leans far more on confirmed closings than on ongoing listing activity. By the time a deed records at the county level, weeks or even months may have passed since the contract was written. In a slow market, that lag barely matters. In a fast one, it produces serious blind spots. The contrast it creates is jarring. On paper, the downturn shows up as a gradual curve, smooth and muted. On the ground, families list their homes at last year's figures and face weeks of silence. They watch nearby sellers hack $30,000 or $40,000 off just to get a single offer, yet their own estimates still look stable. Buyers can see the price-cutting spree unfolding right on the listing pages. Sellers remain guided by an algorithm that hasn't yet processed what it means. Consider an example documented in the recent critiques. A Phoenix area family listed their 3-bedroom home at $525,000 because local estimates supported the range. Within a couple of weeks, not one offer came in. They dropped to $499,000, then to $485,000. Offers didn't surface until $470,000, where they finally agreed to sell. But in the weeks following, Zillow's posted estimate for the property still sat near $510,000 because the model continued to give weight to older closings from 2023 when rates were lower. While buyers could see the discount necessary to move the property, the algorithm needed time, sometimes months, to acknowledge it. The underlying reason isn't deception. It's a structural design. Zillow itself outlines how its estimates work, and crucially, the performance differs based on whether a home is actively listed. When active listings are available, the system incorporates that asking price and related signals, which improves accuracy. Zillow's own published numbers show median error rates of about 1.9% for on-market homes, compared with around 7.5% for off-market ones. That's a vast gap, and it illustrates why Zestimates tend to shadow actual list prices once a home goes live, but lag behind when it doesn't sell or gets withdrawn. If there's no official transaction and no active list price, the model isn't designed to treat a failed listing as evidence of lower value. Here's a way to picture it. Zillow is a rear-view mirror. It gives a clear picture of the road just passed, but it only updates after the car passes the mile marker. By the time you see the last exit, you've already driven beyond it. That metaphor matches the lag in the charts. A Phoenix condo cutting from $1.8 million down to $1.50 and selling at $1.35 doesn't instantly show up reflected in surrounding estimates. For weeks, the system still suggests values near $1.7 million, creating the illusion of resilience while actual deals undercut it. Another behavior flows directly from the way the on-market input works. Zillow estimates tend to shift upward toward current asking prices when a home is newly listed, because the model factors in that seller signal. That explains situations documented in the Close and Business Insider critiques, where Zestimates temporarily nudged higher when homes hit the market with optimistic pricing, only to require downward adjustments weeks later when the inevitable cuts began. The system is designed for scale, not for micromarket timing, and in noisy, falling markets that difference matters a lot. This creates a unique psychological loop. Sellers often interpret the posted Zestimate as an independent check on their own pricing. If it still shows $500,000, they assume their house is objectively worth it, even while buyer traffic tells a different story. They refresh listing photos, hire stagers, or experiment with presentation tricks, convinced the audience will eventually bite. But as many agents can attest, no angle of photography can hide numbers. When half a dozen similar homes nearby have cut down by 40,000, new pictures won't change the outcomes. Yet optimism clings because the algorithm still reinforces it. That behavior translates into negotiation dynamics as well. Realtors frequently find themselves comparing their recommended pricing ranges with Zestimates that sit noticeably higher. Owners resist lowering their sights because they believe the number represents objective truth. Properties overpriced that way sit on the market, sometimes for months, until gravity forces reductions. By the time contracts close, the Zestimate has begun to edge down, but only after painful weeks of missed opportunities and carrying costs. Even in more prestigious submarkets, this lag shows. In parts of Los Angeles, condos or townhomes that eventually closed $500,000 below starting list prices still registered automated valuations close to original levels for weeks. Buyers reading the landscape quickly understand that the charts don't tell the current story. In fact, many approach Zestimates as contrary indicators, assuming high values signal one more overpriced property about to be discounted. What was meant as a consumer guide morphs, in practice, into a signal of how far reality still has to drag the model down. Put together, the effect is less malicious than mechanical. Zillow is a lagging, not a live market sensor. It was built to handle millions of properties through broad comparable analysis, not to react overnight to a sudden rush of seller cuts. In gradual markets, this is fine. During rapid shifts, it distorts expectations. Owners are reassured by smooth chart lines while buyers see rough waters ahead. And when those two perceptions meet in a stalled listing, the gap between optimism and what a check will actually clear becomes painfully clear. This gap is already shaping choice and strategy. Owners cling to valuations with months-old assumptions baked in. Buyers hold back, waiting for visible reductions to accumulate. Agents navigate between the two, reminding clients that automated values are general ballparks. And every time a corporate seller or cash-strapped homeowner slashes a price to actually close, it resets the comp base for everyone in the neighborhood regardless of what the Zestimate says. So while the charts still look like calm ripples, the lived market feels very different. The illusion of stability has power, especially for sellers, but it doesn't erase the harder math waiting for buyers to solve. And when those buyers sit down with real lenders, the numbers they face don't just reflect home prices. They reflect the changing cost of carrying the debt itself, which has quietly become the largest obstacle in today's housing market. Mortgage rates and the affordability wall. Mortgage rates define the real boundary between people who can buy and those who are permanently priced out. The affordability wall is not abstract. It appears in monthly payments that either fit a budget or collapse it. And over the last 2 years, the numbers shifted so quickly that millions of households hit that wall all at once. During the frenzy of 2020 and 2021, buyers barely considered affordability because mortgage money was cheap. 30-year loans often came in below 3%. In January 2021, the CFPB recorded the average at just 2.65%. At that level, a $400,000 loan translated to a principal and interest payment around $1,600 a month, often less than renting an equivalent home. That single factor transformed ordinary properties into magnets for bidding wars. A modest price increase barely registered in family budgets because every $10,000 higher on the purchase price only tacked on about $40 to the payment. It felt manageable, and so prices accelerated far faster than incomes ever could. Then the foundation shifted. By October 2023, average mortgage rates peaked at 7.79% according to the CFPB. That swing nearly tripled monthly interest costs compared to the trough. Using the same $400,000 loan, the payment jumped by roughly $1,265 per month just from the rate change alone. Taxes and insurance pushed the real total even higher. Families who could have managed comfortably 2 years earlier now face a budgeting cliff. That is the affordability wall. It doesn't matter whether a buyer wants the home. The math makes the purchase impossible. The effect intensifies as prices scale up. A $500,000 house at 2.65% felt safe for middle-class households, an attainable dream with two incomes. At 7.79%, it becomes a $3,500 a month liability before any other expenses. Lenders expect housing costs to stay at or below roughly one-third of household income. Cross into the territory where half of take-home pay disappears into a mortgage, and most buyers cannot qualify, let alone feel comfortable signing. This is why analysts describe the market as locked out. It's not about preferences or hesitation. It's structural exclusion. The NAB's Eye on Housing report gives a clear sense of how sensitive demand is to these moves. Their calculations showed that at a 7% 30-year rate, about 31.5 million households nationwide could afford a median-priced new home. Push that rate to higher peaks, and 2.8 million fewer households meet the threshold. That means a small percentage point difference wipes out entire blocks of eligible buyers. It also explains the eerie silence at open houses. One week, a family can qualify to write offers. The next, the same house becomes untouchable because financing terms shifted. This is the paradox buyers face in 2023 and 2024. Prices are technically falling in many metros, but affordability hasn't improved. A home that dropped 10% might look cheaper at first glance, but with current rates, the savings are wiped out. The payment on a $350,000 purchase in 2021 at 2.65% was lower than the payment on a $320,000 purchase today at 7.5%. Prospective buyers run the repayment math, discover nothing feels affordable, and choose to wait rather than stretch past comfort. That waiting game spreads through the system. Sellers grow frustrated as weeks pass with no offers. Builders push back project starts, staring at unsold inventory piling up. Agents juggle strained conversations with clients who want answers, but the truth always circles back to the same root: rates. Until the borrowing cost falls or incomes surge, the affordability barrier keeps transactions frozen. And homeowners wishing for modest discounts won't see relief, because small price adjustments don't offset the surge in interest. Rent versus ownership calculations highlight this contrast more plainly than any trend chart. In 2021, mortgage payments often undercut rent for the same square footage, which gave renters strong incentives to buy. Today, rents in many markets underprice equivalent monthly ownership costs by hundreds or even more than $1,000. When households do that comparison, the conclusion is obvious: renew the lease. Without clear monthly savings, demand stalls. Some skeptics argue buyers will eventually normalize to higher rates. After all, households coped with 7 and 8% mortgages in earlier decades. But conditions then were fundamentally different. In the 1980s or early 1990s, a 7% loan hurt, yet the loan covered a property valued at only 3 or 4 times annual income. Today, those same multiples have doubled in many metros. Layer historically high prices on top of today's higher rates, and the burden is unprecedented. The past comparisons don't ease today's squeeze. They reveal how different the structure is. The Dallas Fed adds an important nuance. They note that falling mortgage rates don't automatically restore affordability, because lower rates can reignite price gains. If buyers flood back when rates dip, the renewed competition lifts home values again, muting the benefit. That makes the impact of rate declines ambiguous, good for payments initially, but capable of fueling another upward surge if supply remains constrained. For buyers, that means the path forward is not just waiting for cheaper debt. It depends on whether prices continue to adjust or snap back against them. On the ground, the affordability ceiling shapes behavior day by day. Sellers host open houses for a handful of visitors instead of dozens. Buyers who do make offers retain leverage by demanding concessions, inspection repairs, or credit for closing costs. Properties listed too high sit unsold until the owner caves to a number that actually closes. Agents know it is affordability setting these terms, not marketing campaigns or salesmanship. When the math fails at the lender's desk, no pitch can salvage the deal. Households that bought into late-stage optimism now bear the sharpest pressure. Variable loans from 2021 or 2022 are adjusting upward, forcing monthly costs hundreds higher. Those who missed low-rate refinancing find themselves trapped. And if incomes can't close that gap, distressed sales begin appearing as owners surrender homes they can't service. Each one adds to local inventory, feeding the cycle further. This is why the affordability crisis doesn't quickly correct even when values soften. A 10% price decline feels dramatic in headlines, but when applied against 7% to 7.5% mortgage money, it barely dents the required payments. To move housing back within reach under present rate conditions, either a steep crash in values or a notable drop in financing costs must occur. Neither has happened yet, leaving the market in stasis. Families eager to buy, sellers eager to move, but the space in between blocked by hard math. For now, the stalemate defines the landscape. Owners cling to appraisals that no longer convert into real offers. Buyers wait for the math to give them room. Each side watches the other, and transactions stall with volume at multi-year lows. Until that affordability wall cracks meaningfully, the cycle cannot reset. And as this freeze persists, it places disproportionate strain on one group in particular: the builders who committed heavily during the boom years. The homes they started when rates were near record lows are finishing construction today, hitting a market where buyers are scarce and carrying costs are crushing budgets. The new construction glut. Back in 2021, optimism was easiest to spot in the sales offices of new housing developments. Builders moved at full speed, carving land into subdivisions and rolling out phases as quickly as they could pour foundations. Waiting lists stretched long, families camped out like it was an exclusive event, and most homes were under contract before a single blade of grass grew on the front lawn. Cheap money fueled the rush. 30-year mortgages under 3% made even large new homes feel within reach. The mood was simple: keep building, because demand looked endless. Today, the same houses are finished, but the demand that fueled them has evaporated. Construction didn't pause when mortgage rates more than doubled. Crews kept pouring slabs and raising frames. Now those subdivisions have completed streets of nearly identical homes with too few buyers to absorb them. What once looked like smart planning has swollen into oversupply, hitting the market at exactly the moment affordability has collapsed. The imbalance is visible in the numbers. Wolf Street reported that single-family housing starts climbed to about 1.01 million in early 2024, the second highest pace since 2007. At the same time, completed single-family housing inventories reached their largest level since 2009. Builders have stacked up homes just as fewer households can qualify for loans to buy them. The mismatches aren't only in single-family homes. Builders also accelerated in multifamily construction. Apartment completions in 2023 reached record highs, and red-hot price growth made large projects look attractive to investors and developers alike. But the picture shifted quickly. While completions kept hitting the market, new multifamily starts plunged, according to Wolf Street. That uneven timing means apartments are still flooding into certain metros, even as forward pipeline work slows. Between subdivisions heavy with suburban single-family homes and clusters of mid-rise apartments downtown, inventory pressure is mounting from both sides of the supply spectrum. For builders, unlike individual homeowners, the burden is immediate. Some families can wait out the market or withdraw listings. Developers with projects stacked in debt financing cannot. Carrying costs, construction loans, and repayment schedules force decisions that homeowners don't face. Hitting quarterly sales targets matters for corporate reports, and that urgency translates into more aggressive cutting. When a private seller clings to $500,000, a builder in the same zip code will gladly accept $470,000 to cash out and move on. That undercut sale then sets the appraisals for every nearby house. What looks like one builder's problem spreads as a neighborhood problem, recalibrating comparables down across the board. Drive the outskirts of Austin or Phoenix, and builder sales offices now advertise incentives in ways that flip the story of only a few years ago. In 2021, buyers brought offers with little leverage, often entering lotteries just to be allowed to write a contract. In 2024, the leverage sits with the buyer. NAB reports confirm the new playbook. Builders are offering mortgage rate buydowns, covering closing costs, and bundling attractive upgrade packages to keep deals alive. These aren't one-off gimmicks, they're industry-wide strategies. Real Wealth noted that finance incentives, especially temporary rate buydowns, are now central to builder pitches because buyers care less about free upgrades and much more about how the monthly mortgage payment feels. Even so, these concessions don't change the underlying math of higher borrowing costs. The glut shifts buyer psychology too. Walk into a sales model today, and instead of urgency, you feel opportunity. Rows of identical homes sit open waiting. Negotiating is expected. Asking prices are treated as starting numbers, and on top of discounts, buyers ask about additional perks. No rush exists, because the sight of visibly unsold houses signals time is on the buyer's side. Where once the scarcity mindset drove bidding wars, visible abundance now breeds patience. Investors aren't immune either. Many assumed buying into new developments would hedge against older housing stock, betting that fresh properties would rent faster or hold resale premiums. But when hundreds of similar builds complete together, there's no premium left. Renters have choice, and for sale buyers see discounts across subdivisions. Instead of security, investors are locked in the same trap, competing against wave after wave of near-identical units priced to move. Builders' attempts to hold the line often involve creative packaging. Some dress cuts as free amenities, granite countertops, smart home packages, or full landscaping. On recorded contracts, the headline sale looks resilient, but the true net shows a hidden discount. Appraisers and lenders understand the adjustments, and buyers recognize when sweeteners substitute for price. Relief. These tactics delay acknowledging the glut, but eventually, visible cuts rewrite the baseline. What makes conditions different this cycle is how uneven the impact spreads across metros. Some close-in neighborhoods still see steady sales, especially near jobs and transit. But only a few miles away, entire subdivisions drag. When city averages show small dips, it conceals that new build clusters might already trade 15 to 20% under their original list. Local homeowners near those pockets can't escape the effect. Discounted builder closings filter into appraisal data, no matter how strong their specific block might otherwise look. Ultimately, the pattern looks straightforward. Supply overextended at exactly the wrong moment, colliding with the sharpest affordability shock in decades. Starts accelerated through 2022 into early 2024. Completions surged, but demand caps shrank. Builders cannot pause completed homes. The result is oversupply pressing downward on values across every channel, while incentives try, mostly unsuccessfully, to bridge the affordability gap. Until the existing pipeline clears, the glut will shadow nearby housing, resetting comps lower by the month. The pace of this reversal highlights just how quickly conditions flipped. A few years ago, prospective buyers camped outside overnight to claim lots. Today, foot traffic comes for information about buydowns and price cuts. The visible excess is reshaping sales strategies, shifting negotiating power, and setting new price floors that drag down entire areas. The issues are not isolated to builders alone. As volumes climb and projects stall, the pressures extend beyond construction and well into financial systems tasked with supporting them. And those pressures are starting to show where few consumers are paying attention. On the balance sheets of the regional banks that finance these developments. The regional bank stress problem. The strain showing up in housing development doesn't stop at unfinished homes or unclaimed lots. It also sits on the balance sheets of the lenders who financed that construction in the first place. That's where the regional bank stress problem takes shape, and why the conversation shifts from landscaping signs and sales offices to the quieter ledgers of local financial institutions. When most people think about a housing downturn, they picture fewer buyers, lower prices, and sellers stuck with stale listings. What rarely comes to mind are the regional banks whose loan portfolios are tightly tethered to construction lending. Unlike the largest U.S. banks, which spread risk across geographies and asset classes, these smaller institutions often concentrate credit in just a handful of local markets. A bank based in Texas or Arizona can have material exposure to subdivisions or multifamily projects rising just a few counties away. When those homes sell briskly, the loans perform smoothly. But when units go unsold, payments slow, schedules stretch, and the once safe assets start looking fragile. The OECD provided a stark reminder of how meaningful this risk becomes at scale. Their 2023 assessment estimated that financial intermediaries worldwide carried about $21 trillion of exposure to commercial and related real estate. That figure captures not only office towers and shopping centers, but also construction lending that overlaps with residential development. While aggregated numbers look massive, the vulnerabilities are sharpest in smaller, concentrated lenders. Within some countries, banks' commercial real estate exposures equal several multiples of their equity, leaving little margin for error. Regional institutions in the U.S. fall squarely into that category. Tightly exposed, lightly cushioned, and dependent on how fast builders can liquidate projects in their backyard. Construction loans add specific risks to this picture. Unlike standard mortgages, these loans don't operate through gradual 30-year repayment schedules. Instead, they are typically structured as short-term, interest-only facilities during the build phase, with repayment tied to closing sales once the project finishes. When sales freeze or projects stall, those loans no longer recycle on schedule. The bank's capital is carried forward, waiting for repayment that may never appear. That creates liquidity stress because the pipeline is jammed. Cash is locked inside half-built houses or standing inventory rather than being freed for the next deal. OECD analysis flagged this precise risk, underscoring how refinance bottlenecks and non-performing loans emerge fastest when sales pipelines break down. In healthy times, that system runs like clockwork. Capital finances land, structures rise, and closings discharge the loan and free up funds for reinvestment. But in today's climate, schedules spin out. Builders with substantial unsold stock delay breaking ground on new phases. They request extensions, seek concessions, or in some cases pause builds. Midway, that leaves banks saddled with loans secured against unfinished or weakly collateralized properties. If area sale prices decline further, the coverage ratios slip beneath the loan balance, compounding losses. The echoes of the mid-2000s are visible here. Then, as now, regional banks tied to overheated housing markets were among the first dominoes to wobble when demand reversed. The structural reason hasn't changed. These lenders live and die within their local markets. They don't have global balance sheets like the largest Wall Street firms. Their real estate books rise or fall with the exact pace of development just beyond their front door. Rapid absorption makes them look brilliant. Prolonged oversupply makes them look insolvent. Stress appears in gradual markers long before it shows up in defaults. At the start, you see repeated extensions on construction facilities, requests for bridge loans, or negotiations over interest accruals. Banks may downplay these items as near-term turbulence. But as inventory builds, as cuts deepen, and as buyers retreat, those marginal adjustments stack up until the strain moves from accounting footnotes to real solvency questions. A handful of underperforming developers can ripple through a regional bank's lending book with surprising force. These financial headwinds don't stay neatly contained within housing. They feed through to the entire credit system that local economies rely on. A regional bank heavy with deteriorating construction loans typically restrains new lending to other categories. That means reduced lines of credit for small businesses, fewer startup capital loans, and tighter household lending even in areas not directly related to residential property. Because housing is so capital intensive, deterioration in that one channel can pull an entire bank's lending capacity inward. Builders themselves feel the constraints quickly. Once their lenders signal caution, whether by raising spreads, demanding extra collateral, or slowing approvals, the ability to start fresh projects evaporates, even if buyer demand hypothetically returns. Stress at the bank level limits future housing supply before a recovery can occur. In practical terms, unfinished projects stretch longer, planned projects are shelved, and labor sits idle. What began as a mismatch between sales and starts now morphs into a deeper cycle of restricted credit and frozen development. The process is self-reinforcing. Banks mindful of exposure press harder for repayment. Builders recut prices faster to free cash. Those lower comps worsen appraisals, deepening loan-to-value gaps. The bank, in turn, demands additional equity injections that developers lack. The cycle squeezes both parties tighter until losses become realized. This is why the narrative around soft landings often misses the deeper leverage pipes beneath the surface. Once those pipes clog, fixing superficial listing prices does little to restore balance. For families watching local markets, these dynamics are largely invisible. You won't find them reflected on Zillow or even in most MLS reports. Instead, the signs show up in subtle ways. Subdivisions with construction halted mid-block, projects frozen after infrastructure is laid, but before vertical builds start, and loan officers at community banks suddenly reluctant to fund ventures they would have welcomed 3 years ago. By the time defaults print publicly, the stress has long been mounting quietly in private conversations between lenders and their borrowers. History reminds us that housing slumps rarely remain contained to visible resale markets. Credit structures support every stage of the cycle from dirt purchase to final sale. And once those structures weaken, the feedback loops spread. Regional banks may never dominate headlines like multinational giants, but their role as funding lifelines for builders and small businesses makes their stress disproportionately important to local economies. OECD analysis reinforces this point. Small and mid-tier banks tend to show outsized sensitivities because their exposure ratios run so high against their capital base. The irony is that these same institutions often thrived most during the boom. Loan volumes surged, fee income spiked, and reporting painted a picture of years of safe profitability. Exactly those aggressive cycles planted the vulnerabilities surfacing today. Expansive credit during explosive demand created loan books that only looked prudent while absorption outpaced supply. Once absorption slowed, the equations flipped, and what seemed like strong assets quickly turned into liabilities, dragging returns downward. The severity depends on time and persistence. Short pauses banks can bridge. Extended impairment they cannot. Each additional season that builders postpone or cut prices pulls valuations lower and collateral coverage thinner. If high rates persist, the exposure grows heavier because refinancing routes are blocked at both the borrower and bank level. The final stress point doesn't emerge sharply in one place. It creeps across assets and loan performance until a wider credit freeze forms. For households or small enterprises in these regions, the downstream effects are not theoretical. Credit limitations that begin in new construction projects show up as restrained lending to local businesses. Expansion plans are put on hold. Job creation slows. Economic activity contracts not because customers vanish, but because credit arteries constrict. Regional bank stress stemming from construction, lending moves directly into broader economic health. This is why focusing only on resale prices misses the broader system. The downturn shapes balance sheets as much as it shapes for sale inventory, and those balance sheets influence whether communities continue to grow or face funding shortages. When regional banks pause lending or tighten standards because of local commercial and development exposures, the slowdown radiates outward, from builders to households to business owners who never thought housing finance affected them at all. And while the strongest signals of these problems emerge in residential development portfolios, the pressure doesn't stop there. It connects to other real estate classes that share balance sheet space in those same banks, meaning the stress in housing links directly to broader market strains that are quickly becoming impossible to ignore. Commercial real estate spillover. Commercial real estate is forcing its way into the housing conversation, not because the two markets usually move together, but because the current stress has created direct spillovers that are impossible to ignore. Office towers and retail properties across the U.S. are experiencing vacancy levels not seen in decades. Remote and hybrid work models are now standard for many firms, leaving entire floors empty in business districts that once thrived. As rental income slips, landlords face mounting pressure to cover debt service on loans far larger than any individual mortgage. With every passing month of high vacancy and falling rents, the financial strain radiates outward, starting with building owners but quickly touching lenders, investors, and connected asset classes. Institutions such as pension funds, insurance companies, and real estate investment trusts hold exposures across both commercial and residential properties. For years, office assets seemed like reliable, cash-flowing investments, complementing housing in the portfolios of these large intermediaries. But as the OECD has noted, when income from commercial properties weakens, institutions face earnings shortfalls that must be addressed. Their answer is rarely to wait years for conditions to normalize. Instead, they rebalance by selling liquid assets elsewhere. Housing often becomes the target because it converts to cash faster than a downtown office tower. A suburban subdivision can be liquidated property by property, providing quick liquidity to paper over losses on commercial balance sheets. This linkage explains why stress in commercial real estate flows directly into residential valuations. What looks locally like a discounted single-family sale may in fact stem from office vacancies 1,000 miles away. The OECD report highlights this mechanism clearly, emphasizing that institutional investors and insurers often dispose of assets in one category to absorb performance gaps in another. In practice, a fund facing tenant loss in its office holdings may list dozens of rental homes at lowered prices, not because those units perform poorly, but because immediate liquidity is required to offset commercial weakness. The broader capital markets reinforce this drag. Commercial mortgage-backed securities, or CMBS, bundle loans on office and retail properties for investors. As the OECD has documented, delinquency rates have risen in office segments, threatening returns for holders of those securities. Mortgage REITs have expanded in this space, taking down more CMBS and assuming greater exposure to defaults. The consequence of weakened office performance therefore doesn't stop at individual landlords. It extends through securitized markets, touching pension funds and insurers in multiple countries. From there, the search for liquidity again pushes investors to sell more manageable assets, residential rentals, developments, or even large tracts of build-to-rent housing. This creates a feedback cycle. Institutional sellers confronting weak cash flow in commercial classes trim residential portfolios to steady near-term obligations. Each residential cut then sets new comparable sales, sliding valuations further. Local homeowners respond by either adjusting lower themselves or watching unsold listings accumulate at outdated prices. Meanwhile, financial intermediaries who see repeated shortfalls must continue freeing capital, pushing more housing stock to market in the process. One market's vacancy becomes another market's price decline. The pattern is not new, but the magnitude is notable this cycle. Past downturns saw portfolio adjustments when certain sectors underperformed. The difference today is persistence. With office vacancies entrenched by permanent shifts in workplace behavior, there is little expectation of rapid recovery. Owners and asset managers managing billions cannot afford indefinite underperformance. Where they find liquidity, residential markets, they act, even if those disposals hurt values in housing further. For households watching from the ground, these links are invisible. A cut to listing prices in their neighborhood doesn't carry a footnote explaining it was triggered by a shortfall in a corporate office portfolio. To them, it is simply one more transaction resetting local comps. Yet in the background, the balance sheet pressure outlined by the OECD is what dictates these decisions. Large funds see assets as interchangeable lines that can be sold, regardless of category. Communities living in those neighborhoods feel the result as price erosion with no apparent local cause. The role of lenders extends the overlap further. A regional or mid-sized bank burdened with struggling commercial loans tightens its credit standards across other sectors. That restraint bleeds into mortgages for families and loans for builders. Liquidity stress from CMBS exposure or stranded office loans thus reduces the availability of financing in residential markets, compounding affordability issues. Credit shrinks not because of housing demand directly, but because stress in commercial assets has left banks less willing to expand balance sheets elsewhere. OECD monitoring underlines how loss propagation operates through these institutional interconnections. REITs tilt between asset categories, insurers balance commercial and residential holdings in the same pool of capital, and pension funds reallocate constantly to maintain funding ratios. When one category, like office, weakens structurally, the liquidation pressures reach into all others. The research makes the link explicit. Rather than sectors correcting in isolation, institutional overlaps allow stress to cascade through a wider share of the property market. This means that even if residential supply and demand were manageable on their own, the drag from commercial markets would still exert downward pressure. Institutions have obligations that transcend local conditions. If cash flow dries up in one set of assets, they respond by shifting the burden to another. Viewed in this way, the housing correction is not a standalone event, but a transmission from commercial volatility into neighborhoods. None of this implies residential values move only in one direction. Liquidity injections can stabilize portfolios temporarily, and localized demand can cushion some neighborhoods. Still, the systemic backdrop is clear. Large, diversified investors operate cross-sector, and their responses to commercial underperformance include real estate sales elsewhere. Buyers who see surprising discounts offered on homes are often witnessing institutional reallocation, not simply local overbuilding. That reality reframes today's housing climate. Price declines in suburban markets cannot be interpreted solely as excess supply or shifting demographics. They are equally the byproduct of large organizations liquidating homes to manage cash gaps in office holdings, retail centers, and broader commercial exposures. Each sale is both a local market event and a piece of a global balance sheet adjustment unfolding quietly behind property-level transactions. Recognizing that connection matters, it prepares households and smaller owners to understand why pricing pressure remains elevated even where demand looks steady. It helps explain why markets fail to rebound quickly, despite appearing oversold at first glance. And it emphasizes how housing won't stabilize fully until commercial pressures ease, a process likely to stretch far longer given structural changes to office demand. As new realities solidify, the weakening of commercial property is likely to keep echoing into residential sales. The OECD's observations about portfolio rebalancing provide the clear framework. When large intermediaries face losses in office space, suburban homes become the liquidity outlet. That dynamic won't disappear quickly, and it adds another weight to the already heavy affordability barriers households face. This interplay raises a different dimension about who historically propped up high-end markets during times of stress. Commercial weakness compounds domestic liquidity problems, but equally important is the absence of an old cushion. Outside demand that once steadied prices in major U.S. metros even during downturns. Without that support, the picture of resilience looks even thinner. The disappearance of foreign buyers. Not long ago, international buyers were a dependable part of the demand picture in U.S. real estate, especially at the top end. Cities like Miami, New York, and Los Angeles benefited from flows of foreign capital, where overseas households treated property ownership as both a status symbol and a financial hedge. Luxury condos and second homes were marketed directly abroad, often attracting all-cash transactions that closed faster and cleaner than deals relying on domestic mortgages. This steady stream of capital gave owners confidence. If local demand wavered, they assumed an international audience would step in. In recent years, that dynamic has weakened in key markets. Foreign investment hasn't disappeared entirely, but regulatory, economic, and currency obstacles have trimmed it down sharply. A stronger US dollar alone makes purchases more expensive for overseas families. When the euro or Canadian dollar weakens against the US dollar, the same $2 million Manhattan condo effectively costs far more in local currency. What once seemed opportunistic now looks overextended. Add to this the increased scrutiny placed on international transactions, tighter money laundering checks and reporting requirements, and the transactions that once moved smoothly now carry more friction. Buyers who valued discretion or efficiency no longer find the same appeal. Outside the United States, governments themselves have raised barriers. Canada illustrates the change vividly. Toronto was long known for attracting overseas demand into its condo market. Developers targeted international capital streams directly, confident that foreign interest would absorb large volumes of new supply. But by 2022, Canadian policymakers moved to restrict those purchases, imposing foreign buyer taxes and eventually temporary bans. The effect showed up quickly in the numbers. According to Deeded and Urbanation reporting, Toronto condo sales collapsed, leaving developers burdened with excess inventory that once would have been carried away by global demand. This case study underscores how regulations magnify currency pressures, together shrinking the pipeline of overseas investors. China also represents a major turning point. For years, families there were among the largest groups purchasing overseas property, particularly in coastal U.S. cities. But today, with domestic housing markets under stress and access to foreign exchange more restricted, fewer households can send capital abroad. Incomes that once supported investments in Los Angeles or Vancouver are instead absorbed by covering losses or servicing debt at home. Alongside this, uncertainty across parts of Europe and Latin America reduces appetite for stretching into U.S. purchases. Families who might once have treated an American property as a safe haven allocation cannot justify the expense while energy costs, inflation, and local downturns weigh on their own budgets. The cooling of foreign demand matters most in the segments where it was most concentrated. In Miami, whole towers were marketed to wealthy buyers from Latin America. International buyers anchored absorption, often paying cash and providing the liquidity that kept projects viable. Now, tightened capital conditions abroad, combined with domestic affordability limits, slow that flow. Developers are left with unusually high unsold stock, some leaning into steep incentives. The absence of traditional international buyers magnifies the decline in resilience that city once claimed. New York faces its own adjustment. Manhattan's luxury condo wave in the mid-2010s leaned heavily on overseas capital to justify both scale and price points. Buildings wrapped in glass and marketed as trophy assets were targeted directly to families in Asia, Europe, and the Middle East. Today, that audience has thinned. Brokers report that units that would have attracted active interest from abroad just a few years ago now sit for months. Domestic buyers alone cannot sustain the velocity or pricing that developers baked into their models. As a result, quiet but steep reductions are increasingly common, especially in high-rise projects meant for an audience no longer present. Los Angeles feels the same strain through a different lens. Its appeal as a safe location for vacation properties and prestigious homes in Beverly Hills or West Hollywood relied significantly on global wealth. The pricing assumptions for many listings presumed that overseas buyers would continue to backstop values in those enclaves. With stronger dollar dynamics raising effective costs, and with economic turbulence abroad pulling liquidity back home, those assumptions weaken. Now high-end properties cycle through price cuts and prolonged listings, relying on a thinner pool of local buyers navigating expensive financing instead of cash-heavy overseas households. These quantitative changes feed into the psychology of sellers. Homeowners who once firmed up their asking prices by invoking international appeal find themselves disappointed when offers never materialize. Instead of waiting confidently for an overseas cash buyer, they have to face the local reality. Prospective buyers who must finance purchases at rates above 7%, or who cannot stretch to match valuations inflated by international demand of the past. The gap between past expectations and present reality leaves many listings languishing. Overconfidence built on global prestige often turns into price cuts months later. For developers, the gap bites even harder. Entire financing packages were structured around international buyers. Marketing budgets were allocated overseas. Performers assumed faster absorption and higher price ceilings made possible by foreign inflows. When that inflow faltered, projects already launched had to adjust. Developers slash prices earlier, expand incentives, or delay completions. The structural weakness in absorption linked to diminished global demand thus accelerates corrections, not just on individual units, but across whole classes of product. The story is not simply absence, it is rebalancing. Markets once described as global epicenters now find that local fundamentals are more decisive. Miami relies more heavily on domestic incomes. New York City's luxury sector leans far more on U.S. buyers rather than international cash. Los Angeles learns that affluent local demand cannot indefinitely carry valuations once underwritten by global wealth. Cities that felt insulated now move in step with national downturns. Price cuts spread faster, inventory lingers longer, and the assumption of endless outside capital fades. Research underscores the consequence. With policies restricting foreign purchases in Canada, deeded and urbanation recorded a collapse in Toronto condo sales. A similar logic applies in U.S. metros reliant on overseas flows. The protective demand floor is weakened. Without international capital, price corrections proceed without the catch that once cushioned declines. Luxury units in Miami, Manhattan, and Los Angeles correct more sharply not because the product is undesirable, but because the buyer pool is smaller and less insulated from rates, affordability, and macro stress. The long-term outlook may not spell permanent retreat. Global conditions change, currencies fluctuate, and overseas interest may eventually return. But at this moment, diminished demand abroad exacerbates pressures that were already in play. Mortgage rates, local affordability constraints, oversupply, all are magnified when one of the market's safety nets has shrunk. This explains why luxury segments in high-cost metros are recording deeper, quicker drops than headline numbers suggest. That leaves both homeowners and developers recalibrating expectations. They cannot assume an outside buyer will arrive with cash to support lofty valuations. They must instead compete directly for scarcer, cost-constrained domestic demand. And when their expectations of effortless global absorption persist, listings stagnate, then cut. That gap between expectation and reality isn't confined to the foreign buyer story. It shows up just as forcefully in how individual sellers respond to shifting conditions in their own neighborhoods. Many still price homes as if yesterday's market remains intact, refusing to accept offers, withdrawing listings, and waiting for a rebound that may not come. The disconnect between belief and reality is powerful. and it shapes how downturns are experienced on the ground by ordinary sellers every day. The psychology of sellers in denial. Some of the sharpest disconnections in this market come not from data, but from human behavior, and nothing illustrates this better than the psychology of sellers in denial. Families who saw their property valued at $500,000 in 2022 often refuse, offers tens of thousands below that figure today. Instead of adjusting quickly, they cling to their initial list price, treating silence from buyers as temporary rather than structural. When the offers never arrive, many withdraw their listings altogether rather than cut. At first glance, numbers make this resistance appear justified. Headline indices show mild declines, and automated valuations often sit close to last year's peaks. But those averages conceal what's happening on the ground, because withdrawn listings don't register as lower sales. They register as nothing at all. Data appears stable only because reality has been scrubbed from the record. Wolf Street and others have pointed out how this distorts the picture. In Atlanta, for example, active listings as of 2023 were up 254% compared with 2022, yet median price data suggested only a slight dip. The reason is simple. Many owners holding out at peak prices vanished from the stats instead of becoming visible discounts. Headline averages understate local distress whenever homes don't transact. Institutional sellers create the opposite dynamic. Unlike families wrapped in emotion, funds and builders reduce prices mechanically when performance slips. Their losses appear immediately in county records and MLS feeds. A Blackstone-owned property cut multiple times and finally sold well below its prior estimate. Those figures reset local comps overnight. Where a withdrawn home masks decline, an institutional sale cements it. This is why markets can seem placid in official data, yet feel brutal on the ground. Institutions reveal the true valuations faster, dragging neighborhood benchmarks down while private owners stall in hope. The standoff creates confusion for anyone tracking conditions. Sellers tell themselves the right buyer just hasn't come along. Buyers, looking at discounted portfolio sales or nearby concessions, see a market already down 10 to 20%. Each side operates under a different perception of value. The longer denial holds, the worse the eventual reset, because one confirmed transaction below the anchor price erases months of wishful thinking. There's also a personal dimension. For many households, value isn't simply a number. It's their savings plan, their measure of success, even part of their identity. Accepting a lower offer feels like more than financial loss. It feels like failure. Overpriced listings become a coping mechanism to avoid that reckoning. But a house priced 15% above buyer demand isn't really for sale. It's an emotional placeholder. Each refusal to cut delays liquidity until the market forces acceptance. And while one owner's pride may stall a sale, investor discounts nearby enforce a hard truth. Recorded comps will set value whether individuals recognize them or not. For viewers, the practical side matters most. If you're planning to sell, check closed house data and active price cut counts in your zip code, not just Zillow's median. Those are the real signals. Spreadsheets and algorithms may lag, but the offers written, the reductions made public, and the comps stamped into deeds define reality faster than averages. This denial phase explains why downturns feel uneven and why official reports always seem calmer than people's lived experiences. Withdrawn homes make the data look gentler, but institutional disposals keep carving lower comp lines. Eventually, recorded sales overpower expectations, and stubborn sellers are left adjusting to prices written into public record. At that point, denial collapses, and corrections reveal themselves all at once rather than gradually. The distortion created by this dance between hidden withdrawals and visible fire sales sets an unstable stage. It explains why two neighbors can hold completely different beliefs about the same block, and why averages rarely describe what buyers actually face when they write offers. The market always resolves around real transactions, not asking prices. And as institutions and compelled sellers print more of those lower transactions, they set the terms everyone else must acknowledge. What this means is that today's market feels split. Families hanging on to yesterday's numbers, institutions enforcing today's discounts, and agents caught in the middle trying to reconcile both. But buyers and renters watching closely face the same data with very different incentives. For one group, the temptation is to wait, for the other to act. And that divergence shapes the choices being made right now on the demand side of housing. where this leaves buyers and renters. 4 households trying to decide their next move. The split between ownership and renting has never felt sharper. Buyers are looking at mortgage payments that far outpace local rents, while renters face bills that remain high even as headline home values slide. This is the heart of the trade-off. For many families, buying today would push housing costs well above comparable rents. Yet staying on the sidelines carries the risk of future rate shifts that could erase potential savings. According to the CFPB, the average rate jumped from 2.65% in January 2021 to 7.79% in October 2023, which raised the monthly payment on a $400,000 loan by roughly $1,265. The NAB adds that every percentage point increase in mortgage rates knocks millions of households out of purchasing range entirely. That is the arithmetic buyers are forced to weigh. Own now at higher cost, or wait and risk affordability tightening further. Renters encounter a different calculation. While they avoid locking into decades of debt, they continue paying monthly rates that rarely move down even as homes around them lose value. Pandemic-era rent spikes hardened into lease structures, and though some national reports suggest relief, most households see renewals only slightly softer than before. The reality is that rental markets adjust unevenly. Harvard's Joint Center for Housing Studies noted record levels of multifamily construction underway in 2023, and John Burns' data shows sharp increases in apartment completions in certain metros. That incoming supply has forced concessions in places like Phoenix, Austin, and parts of Florida, offers of 1 free month, lower deposits, or bundled perks. Yet in other cities where supply is tighter, rents are still rising. The actionable point for tenants is to check local listings carefully and negotiate. Concessions often hide beneath stagnant headline figures. Put together, buyers and renters are navigating the same storm, but through different channels. Buyers must balance the elevated cost of ownership against the danger of waiting too long, while renters need to separate national averages from what landlords are actually offering in their zip code. The practical verdict is simple. Both groups must study real comps and local lease terms rather than trusting broad national narratives if they want an accurate read on their position. That gap between what the data implies and what people actually experience is the recurring thread. And it sets up the larger truth at the center of this entire story. The public narrative looks stable, but the ground-level signals continue to tell a much rougher version of reality. Conclusion here is straightforward. The surface calm presented in headlines and automated estimates hides deeper structural stress. Just one example. The CFPB shows the payment on a $400,000 loan rose by about $1,265 between the low-rate trough and the 2023 peak. Illustrates why affordability has collapsed far more than official averages suggest. For anyone navigating this market, the practical guidance is clear. Watch local closings, track inventory and price cut shares in your own area, and ask whether your decisions follow emotion or math. Opportunity exists for well-prepared buyers who understand those signals. Share what you're seeing in your market below, and subscribe for more data-backed breakdowns.